My name is Rory Johnston, and I cover commodities at Scotiabank in the economics department. So generally, before I start out, I just want to kind of provide a little bit of historical context to what we're seeing right now in the commodity markets. So in the mid 2000s, 2004, 2005, depending on when you benchmark it, you saw an overwhelming rise in commodity markets, in commodity prices across the spaces, from agriculture to metals to energy, etc. These were very much demand-driven developments from the rise in China, from the rising economy in China, and its voracious appetite for raw minerals. So what really happened here was it was the pace of demand growth that really pushed, it tightened supply chains, it tightened labor markets, it tightened service markets, it tightened capital markets. All of these things contributed to ever rising prices. So when you looked at a cost curve, which is very much a snapshot in time, people said, oh, well, the commodity prices can't fall below these levels because they would be below cost, and therefore supply would contract and the market would reassert itself. But people often forget that cost curves are moving targets, and that as prices fall and the demand for labor, for capital, for services falls, those cost curves fall at the same time. They drift lower, not quite as quickly as the price, but the price definitely brings them down. So now prices have fallen, costs have fallen. And I really do think that the latter half of 2015 and the beginning of 2016 was the bottom for commodity markets as a whole. However, while they all trended down together, we really do think that now on the way back up, that's when the differentiation starts. These minerals and commodities have very different fundamental characteristics at this point. So this is my price deck right now for all the metals, base, bulks, and precious. And you very quickly see two groups emerge. So the outperformers, and you've seen them this year, zinc, nickel, and most notably, in many ways, coal. All of those have been spurred higher by supply contractions. In zinc, it was actually I'll come to that later, but so those were all supply-driven contractions rather than the demand that pushed them up in the previous supercycle. The laggards, however, have still reasonable demand prospects, but they have no supply contraction. In many of these markets, supply has been stubbornly sticky. So as a general theme going forward, I do think two things: the rising dollar and the Beijing's recent attempt to curb commodity speculation on, particularly in the Shanghai market, will provide some moderate headwinds to commodity prices at levels. And from there we'll kind of go forward and look at each commodity individually. But before going to the metals, I do want to quickly touch on oil. So oil, as many know, largest commodity market by far in the world, and it trickles through to basically every other part of every other industry. It makes mining costs more expensive and generally puts inflationary pressure on the entire globe. So the big story right now is that we may see an OPEC cut at its November 30th meeting later this month. What that doesn't tell you, so there's a lot of speculative fervor again ahead of this meeting. You're seeing options positioning spike. You're seeing all of these financial market players tend to kind of take bets on which way this is going to go. But my argument is that even if we do see a cut, which is kind of demonstrated in those light gray bars at the bottom, we really still don't see much of a deficit. It would put the market clearly in a deficit, but we need substantial deficits for a prolonged period of time to bring us back to anywhere near more typical levels of inventory. As you see at the bottom chart right there, you saw this huge rise up as the prices fell, which is what pushed the prices down in the first place. And that tiny little sliver at the top there would be the difference between no OPEC cut and an OPEC cut based on our recent models. So our base case right now is that there will be some kind of OPEC deal, but it won't materially affect the market. This morning there were reports that sources inside OPEC say that they're aiming at 4.5% reduction in production, which would bring them roughly in line with their stated goal. So we do think that'll have an effect on the market, but not materially. The other big thing that everyone's talking right now is the election of Donald Trump and what effect that may have on the oil market and commodity markets more generally. I think I think it's moderately bearish for oil, and the reason being is that it makes a deal with OPEC a little bit harder because Iran has the possibility of seeing sanctions re-snapped on. You're more likely to see a lot more supply coming from the United States at any future price level because of a rollback of corporate taxes, of environmental and leasing regulations, and the opening of federal lands. The other thing is in Russia, there was a lot of talk about how Donald Trump may be slightly more amenable to the Russian administration than Hillary Clinton would have been. Now, this makes me think that there's more likely to be a rollback in financial sanctions from the United States to Russia. And one of the major things holding back their expansion of their supply that they've been looking at right now has been a lack of access to global expertise and global capital markets. So if you roll back those sanctions, all else equal, slightly more supply from Russia. So, moving from oil into the metals. So copper is one of my favorites. It's very important to the bank. Unfortunately, it's also very uninspiring right now. Prices are expected to remain roughly flat at $2.20 a pound before rising marginally into end decade. So there's a couple things behind this. One, like with many of the commodities we will see, you have a wave of supply coming online between now and 2018. You've seen ramp-ups primarily in Peru and other Latin American countries that you have a lot more concentrate coming to the market. Now that hasn't quite shown up in metals balances yet, but as those concentrates work their way through the smelters and the refiners, we'll start to see those factors build up. And I'll touch on the recent price spike in a minute. So that said, on the longer term, we do think that copper fundamentals are still relatively strong. It's the metal that's most associated with electrification, which we continue to believe will be one of the dominant trends going forward. Smart grids, electric cars, etc. So that's generally where we see the fundamental balances going. However, there was this recent and very material price spike. Some have called it the Trump bump. Others have just kind of explained it away based on some kind of speculation. I'm more in the latter camp. So the story here is that in the first half of the year, there were very, very low disruptions. Typically, copper mine disruptions run at about 5% average of total mine capacity. In the first half of the year, they were running under 2%. So we had a lot more supply than we were even expecting, and we were all expecting to have more than enough supply. However, those disruptions started to spike up in the third quarter. This was a much discussed facet of the market at LME Week recently, and what you saw coming out of LME Week was there was this new story about more disruptions and slightly stronger Chinese demand that added a little bit of fundamental support that was much needed in the copper complex. However, as it pushed outside and above that $2 to $2.30 roughly a pound price band, you saw a lot of speculative positioning flood into the market. That pushed the price higher and higher and higher. And just as Western financial players were starting to take profits, you saw a lot of Chinese speculation kind of jump in as well. Now that is part of the speculation that we do think that Beijing is trying to rein in a little bit. But that's for us the main story with the current spike in copper prices. So it would be nice if they stayed up, but we don't expect them to. And the line there is kind of where we see it falling back and hovering around over the most of the next year and into 2018. Zinc is the happy metal right now. Everyone loves zinc because it's pretty much the only really, really good story in the base metals complex from an optimistic perspective. You've seen a significant lack of supply additions coupled with fairly notable large mine closures. So you had Century in Australia and Lachine in Ireland both closed because of mine depletion last year and the year before, and that was coupled with Glencore's decision to idle roughly 500 or 500,000 metric tons of annualized mine capacity until prices recover. So there's still a little bit of a question of when Glencore's mines come back. We have it roughly in our estimates latter half of 2017 with roughly a 6 to 8 month ramp up from there, but it doesn't really change the fundamental picture. There's not enough supply. And as you see at the bottom chart, as those inventories start to drop off from very high levels where they were, they really descend very quickly through that average 78-day of demand cover. And as those prices go down, we expect prices to spike up rather dramatically. Prices are expected at about $1.25 next year, $1.55 in 2018, and then as you see, it kind of spikes. It kind of reaches its crescendo there in 2019 at, we estimate, about $1.75 a pound. Sorry, $1.65 a pound. Then those mines start to come back, and the inventories start to rise again, and the market calms down, and we start to see that price fall back down into that longer-term sustaining price that we estimate at around $1.20 a pound. Nickel is another one that has had significant supply curtailments recently, but while in zinc, it's an organic and it's a sustainable story. In nickel, it's much more, they're temporary, they're illusory really, because they're all based around political risk developments. First, it was Indonesia that banned the export of raw nickel in order to develop its own domestic processing industry in nickel pig iron, and then later it was the Philippines, and President Duarte has taken a very hardline stance with the domestic nickel industry, and Philippines now, after Indonesia, is the largest supplier of mined nickel in the world, and the primary now supplier to the Chinese industry. So all these things have taken a lot of nickel off the market, but we do expect that to come back in due course. However, nickel is the metal with the most astronomical inventory levels. You have a lot of inventory that's built up well above the levels seen in any of the other metals, and that'll take roughly until end decade to work off back to roughly average levels. We expect the price to come up commensurately, and nickel. And part of the reason for this, is that nickel miners tend to be ever optimists, and our forecast doesn't help that problem because we do see the price recovering, but nickel miners globally have been very hesitant to take off significant mine supply because it costs more to shut a mine than just to keep producing for a year, and they always hope that there's going to be kind of a renaissance the following year, which we do expect by end decade. Aluminum, however, is the one with the least promising outlook, and I'll only spend a very little bit of time on aluminum because very few people ask me about aluminum on a regular basis right now. The story is that you have tremendous overcapacity throughout the entire industry, subsidized smelting capacity in China, and tax incentivized refined product exports out of China. So there's just a structural issue in the aluminum market that we don't see properly resolving itself until there is a conscious effort from Chinese authorities to kind of adjust this or roll back those subsidies and let the market take a stronger role. But we don't fully see that through the end of our forecast horizon, which is why prices stay relatively muted throughout that period. However, the biggest surprise so far this year has been coal. The coal prices has risen 300% since the beginning of the year, particularly in coking coal. And this was really a perfect storm of again, supply disruptions. There was the reduction in Chinese mine policy days that reduced the allowable working days from 330 to 276 days, effectively taking massive amounts of supply in the market because it is the world's largest supplier. There were Australian mine disruptions. There was flooding in the interior of China, primarily where this coal is produced, that disrupted shipping lines between the interior and the coastal regions where most of it is consumed. Also, you had what was the last one? Rising steel production. That was with all of this Chinese stimulus, there's really stoked the commodity markets higher in pretty much every way in the first half of this year. It also spurred a dramatic increase in Chinese steel production, which increased coking coal demand, and that's basically how you get a price rising from $80 a ton to over $300 a ton in a matter of months. We don't see this lasting. Once again, if wishing made it so. You've already seen the thermal coal price fall off pretty dramatically, and we expect the coking coal market to follow a similar path, reaching roughly about $150 a ton by, or sorry, $130 a ton by mid next year, and we have a forecast for about $140 a ton overall for next year. That's due to a variety of reasons. We definitely see significant or notable mine expansions reopening or unidling in Australia and North America, where many of these mines were idled because of the low price environment. We also see steel producers are making very little money in China right now because of the increases in coking coal and the fall off in steel prices. So that combined, the coking coal has to kind of come back into balance, and we do see significant supply additions in the next 3 years, erasing the deficit that we see this year. Iron ore is another similar story to copper, really. There was a period of very, very high prices that stimulated a lot of new demand that came on, that is coming online and continues to come online, primarily in Brazil, Australia. One of the saving graces more recently about iron ore is that many of these producers have shown a willingness for cost discipline, for production discipline rather. They're focusing on profitable tonnage rather than total volume. They're reducing and slowing the ramp up of their mines to allow for market conditions to ease a little bit, or sorry, to tighten a little bit in order to prompt more of their tonnage onto the market. But we do think that steel in particular has a slightly lower demand outlook over the next couple years because of the fact that the current round of Chinese stimulus didn't really serve to create new demand. It really just borrowed future demand and pulled it forward. So eventually we're going to kind of have to deal with that lower demand in the future that's been stimulated through credit booms now. And finally, gold. Gold prices have been notoriously difficult to forecast. We tend to take the approach of a fairly steady relationship over time between global interest rates and gold. With gold, there's a negative correlation as the interest rates rise. The opportunity cost of holding non-yielding assets like gold decreases, and that's so what you see here. And I'm kind of a fan of this bottom chart because it just kind of shows the waves that gold moves through. That those shaded areas at the bottom actually track the deviations from that trend line. And what you see is during periods particularly of significant political stress and particularly financial market stress, like with the Eurozone crisis, you saw a significant premium to this relationship open up in 2011, 2012 during the Eurozone crisis. And that's, interestingly, it's actually declined now. So technically, gold seems to be slightly undervalued at current prices. However, we do expect yields to increase over the coming years. Our capital markets economist team has bond yields increasing to 2.6% by the end of 2018. However, what you do see is, particularly at the lower levels, this price and this discount to trend tends to move a little bit, particularly at those lower levels. You can see it tracing the ups and downs at the bottom there. So we do have that discount coming up, and you generally have about a $1,300 an ounce price for 2017 and 2018. That said, the other thing that can be said about gold is the safe haven and the risk. It's essentially a fear derivative in many ways. The challenge with that is that there's a tremendously uncertain global outlook at the moment. Aside from the uncertainties with the newly elected U.S. administration, there are roughly 24 various referenda and elections going on in the Eurozone next year that could really damage the long-term viability of the union. So we do think there's lots of potential headline risk that can flash gold higher in the short to medium term. Unfortunately, it's just very difficult to predict which exact referendum is going to skew dramatically off polling or anything else like that. So we'll be watching carefully. We monitor these things on an ongoing basis and keep general base cases for most of them. But again, as we've seen this past year, polling and forecasters and media and basically everyone else has been wrong on multiple occasions. from Brexit to the U.S. presidential election to even the peace treaty referendum in Colombia. So all of these things, the populations are getting very, very difficult to predict politically because of the rising anger in many of these populations that throw off historical relationships between individual groups and voting turnout, for instance. So it's making it all very difficult to follow. With that, this is just my slide that provides a nice little commodity snapshot. So at this point, I'll take any questions if there are some, and I'll leave this up in the background. Sorry, first, legal disclaimer, I am not a registered investment consultant, so I'm just going to go back now.
Donc, vous pouvez, il y a des micros, il y en a un là au moins. Donc, un autre là, oui.
Hi.
Hi.
My name is Pierre Lafleur. I'm a consultant. I do a lot of cash flow analysis based on mineral resources 43-101. We have for 43-101 to make forecasts for mineral prices, or we should. So what should we do? Call you, or do you have a method you can teach us? And I would like for you to comment about foreign exchange.
Foreign exchange, okay.
I consider personally the model of supply and demand to be total failure. Account for only 20% of the metal price changes, given the fact that the offer and supply demand model by Marshall was proposed in 1890 when we were under the gold standard and commodity markets were much more stable. I consider that today the driver for metal prices is foreign exchange, and especially the US dollar, which you seem to consider a mystery to explain the price of gold. Thank you.
Thank you. So always feel free to contact Scotia Economics for any commodity price forecasts. But more generally, I think you are right. There's, particularly in the short run, there is a very tenuous relationship between supply and demand and price. We do see a stronger relationship on an annualized basis. So for instance, if you go back to some of the other slides with, for instance, zinc, you do see these spikes not in exchange listed inventory, but in total inventory. One of the many problems with analyzing metals markets in particular is their vast opacity. There's very little data on the entire industry available. So what we do is we deal with individuals that can provide us mine by mine supply assessments, and then we base our demand numbers on other sources and try and build a ground up approach to supply and demand. But these are implied volumes because the exchange listed on the LME or SHFE represent a very small portion of the market, and they tend not to actually track one-to-one. So total inventory could be increasing at the same time as exchange listed inventory is actually decreasing. Now a whole variety of things drive that exchange arbitrage, etc. At any given time, there's usually a couple boatloads of metal just being shuttled in between SHFE and LME to kind of capture that arbitrage and close those arbitrage opportunities. But I will give you that foreign exchange markets definitely do make it very complicated right now. Not only in the fact of the U.S. dollar as a total trade weighted, or DXY, or whichever index you use. A lot of these currencies have a huge effect on costs. I mean, a great example of this is in Brazil. In Brazil, you've seen, for a whole variety of reasons, from the economic recession to the political scandals, you've seen the value of the real, fall considerably over the last 2 or 3 years. This has dramatically decreased local operating costs of iron ore miners, which made it far more easy for those suppliers to compete with, let's say, competitors in Australia, which, while their currency did decrease, it didn't decrease at the same degree. So it's tricky to kind of build a total cost model of the industry based on constantly shifting foreign exchange values. We have models that generally do that, but it is an inexact science, and that has a good deal to do with the fact that there isn't the transparency in the market that we're even able to constantly check our assumptions. We can't go back to 2004 and say, well, this is what we thought total inventory in the market stands at, and that includes all inventory, suppliers, consumers, et cetera. It's very hard to check those numbers to validate your own models, but based on our histories here, you do say there are strong relationships with total inventory, but they do take a while to work through. The other important thing is to remember is that even though inventories may be falling, if they're still, in nickel's case, considerably above average levels, it's really only a slight improvement in an already dour situation. But as this year has shown us, forecasting is a very fraught industry. So take all of our forecasts with a grain of salt. Any other questions?
Could you go back to aluminum, please?
Yes.
I don't quite understand why it's dropping from your explanation.
So the aluminum inventories are slightly above their level, but not considerably. It's more the fact that unlike with, let's say, copper, where the market can even get ahead of the decreases towards average levels, with aluminum you don't really need to incentivize new mine supply. You don't really need to incentivize new smelter supply because of the degree to which it's also subsidized, particularly in China. The assumption is that supply will just come up. I mean, aluminum demand continues to grow at very rapid levels, but supply can always catch up. Every time you think it can't, a new smelter opens and we've got more aluminum. So it doesn't seem to actually be dependent on price, which is why aluminum is essentially flat. We have it rising slightly, and we have a higher long-term incentive price if that was a factor. But given that incentives don't seem to be a factor in the aluminum industry as a whole, it's very difficult to come up with an accurate incentive price. So that's generally why we don't see that. Aluminum's a little bit of a broken market in many ways because of that factor. And one of the things I actually forgot to mention about aluminum is that you will actually see with the current ramp up in coal prices, you will actually see a very interesting dynamic within China. So there are largely three different classes of aluminum producers in China. You've got because of the fact that it's so electricity intensive. In some of these cases, you have smelters that have direct access to their own thermal coal supplies. So there's an entire closed supply chain. They just supply it all. So the price bump won't really hurt them, except maybe in opportunity cost terms. The second group is producers that have let's say long-term contracts with power producers. So they will start to feel the pinch, but only after a lag time because of the way these prices adjust themselves to market conditions. The last group is the one that's most exposed. They're the producers that have a lot of their own smelting capacity, but they have their own power stations and they buy coal from the market spot. They're the ones that are most exposed to this current spike, so it'll be interesting to see over the next year as these prices wiggle their way through the aluminum market, how much these different classes of aluminum producers react. And I think to that point, that could actually start to provide a little bit of illumination on where incentives could be going. But yes, aluminum is a little sad right now.
D'autres questions? Donc, merci, M. Johnson.
Thank you so much.